Welcome to Lesson 8. Today we cover accounts and taxes, because keeping what you earn matters as much as earning it. A $10,000 gain that loses $3,000 to taxes leaves you with $7,000. Same effort, less cash in your pocket. Wouldn't you rather keep more of what you make? We'll use a US and global framing. This is general education, not tax advice. Tax rules change often, so always check the latest IRS guidance and your broker's materials before you trade or file. You'll meet the main tax-advantaged buckets: Roth IRAs, traditional IRAs, and 401(k)s, and see how they differ from a regular taxable brokerage account. Even a $10,000 investment profit can shrink a lot once taxes take their cut. Example: you sell shares in a taxable account after holding more than a year and book a $10,000 long-term capital gain. At a common 15% federal long-term rate, that's about $1,500 in tax, so roughly $8,500 stays with you. State tax can add more, depending on where you live. Now flip it. The same $10,000 gain as a short-term trade, held under a year, is taxed as ordinary income. In a higher bracket, that can mean 30+% federal tax, so $3,000 or more may leave before you see a dime. That's why taxes matter. The same 10% market gain can feel like a full 10% in a tax-advantaged account, or closer to 8% after a 15% long-term tax, or even less after short-term rates. The usual order of operations: max the tax-advantaged accounts first, 401(k), IRA, Roth, then use a taxable brokerage for anything extra. What taxes hit you when you buy and sell stocks in a regular taxable brokerage account? More than beginners expect, but still manageable if you plan ahead. For most everyday investors, U.S. stock profits are capital gains. Hold longer than 1 year, and you usually get the long-term rates, commonly 0%, 15%, or 20% federally, depending on your income. Hold 1 year or less, and short-term gains are taxed like wages. There's no tiny stamp tax like some other countries charge on every sale. Instead, you pay when you realize a gain. Sell $10,000 of stock with a $1,000 profit at 15% long-term, and the federal tax is about $150, not nothing, but far smaller than a short-term hit. Dividends are different. Qualified dividends from many U.S. companies are often taxed at those same preferential long-term rates. A $500 qualified dividend at 15% means about $75 goes to the IRS. Your broker usually reports this on a 1,099 div. You still include it on your return. Rules change and your situation is personal. Before you trade, check the latest IRS publications and your broker's tax center, especially anything about cost basis, wash sales, and which dividends count as qualified. Two situations feel heavier than plain long-term U.S. stock investing: short-term trading and stocks you buy abroad. Work a short-term example. A $5,000 gain on a trade you held only a few months might be taxed at ordinary rates, say 22% federal. That's about $1,100 in tax, leaving roughly $3,900. A $10,000 short-term gain at 22% is about $2,200 owed. You can net losses against gains in the same year. 5,000 of gains and 2,000 of losses leaves 3,000 of net gains to tax, so the bill drops. Unused losses can often carry forward, subject to IRS rules. One more critical point: your broker reports sales to the IRS, but you still file. Miss capital gains reporting, and you can face underpayment interest and penalties. Mark tax season on your calendar. Don't wait until April to dig up trade history. Foreign stocks and ADRs can add another layer. The foreign country may withhold tax on dividends, often around 15%, and you may claim a foreign tax credit on your U.S. return. If dividends get large, Ask a tax pro or check IRS guidance before year-end. First, tax-advantaged account, the Roth IRA. Think of it as a pay tax now, grow tax-free later bucket. You contribute after-tax dollars. Then qualified growth and withdrawals in retirement are generally federal tax-free. Contribution limits change yearly, recently on the order of $7,000 for many adults under 50, with a higher catch-up if you're 50 or older. Income limits can phase out who can contribute directly. Example, suppose your Roth investments gain $3,000 over the years. In a taxable account, that same $3,000 at 15% long-term might cost about $450 in tax when sold. Inside a Roth, a qualified withdrawal can mean zero federal tax on that growth, a huge difference over decades. Inside one Roth, you can hold U.S. stocks, international stocks, and more. One account, many building blocks. You don't need a separate tax shelter for every ticker. The trade-off: early withdrawals of earnings before age 59 and a half and before meeting the 5-year rule can trigger taxes and a 10% penalty. Start a Roth when you can leave the money invested for the long haul. 2 more workhorses for retirement and taxes: the traditional IRA and the workplace 401k. The core idea is tax deferral, and often a deduction today. Traditional IRA, illustrative mid-2020s numbers if you're eligible to deduct contributions. Putting in $7,000 could cut taxable income by that amount. In a 22% federal bracket, that's roughly $1,500 of tax savings this year, so the out-of-pocket feel is closer to $5,500. A 401k is the workplace version. Contribution limits are much higher, recently around $23,000 plus for many under 50 workers, with catch-up amounts if you're older. Always grab any employer match first. It's free money. Example, contribute $12,000 to a 401k and $5,000 to a deductible IRA in a 22% bracket, and the combined federal tax savings can land near $3,000 to $4,000 that year. Exact figures depend on your income, filing status, and deduction eligibility. The catch: withdrawals before 59 and a half usually face ordinary income tax plus a 10% early withdrawal penalty. Treat these accounts as true retirement money you plan to leave alone. Lesson 8 in 3 beats. First, in a taxable brokerage, long-term U.S. stock gains often face preferential rates, commonly 0/15/20% federal, while short-term gains are taxed like ordinary income. Qualified dividends usually get the preferential treatment too. Second, short-term trading and foreign holdings can cost more, higher rates, extra paperwork, and possible foreign withholding. File what you owe. Penalties hurt more than the tax itself. Third, fill accounts in this order: Roman first 401k, at least to the employer match Roman, then IRA/Roth, tax-deferred or tax-free growth, Roman, then taxable brokerage for the rest. That sequence usually maximizes what you keep. Tax law is reviewed and revised often. Check the IRS and your broker every year. Contribution limits, brackets, and capital gains rules all move over time. Next, Lesson 9 covers how to place orders. This course is for education only, not investment advice or a recommendation to buy anything. You own every trading decision you make.